why do people do this? Loan interest rate 5-6%. Reduces stress because they can pay off their debt. Gives you control over money. Money keeps compounding when I take loans.
Why do people do this? Main reason, money keeps compounding for you, can pay off debt, while my money still works for me. How does it work? First is to put money into a life insurance policy. The focus is the cash value, not the life insurance. Cash value will grow over time, dividends and interest that I receive from the life insurance company, and then how I use it to pay off debt. Take policy loans against the cash value, and then once I've paid off the debt to the third-party institution, bank for example, now what I can do is to begin to repay policy loans. And after repaying the policy loans, the cash value is fully restored to what it would have been as if I just let it sit and grow in the first place. The reason why is because once passes through the cash value of a whole life insurance policy, that dollar is earning, call it 5%. It don't matter if you let that dollar sit and grow, or if you decide to borrow against it, you take a loan against your policy. Say you loan 50 cents of your dollar, you still get 5% on the full dollar. It's a lot like real estate. We'll pretend we have money in a bank account. So example, let's assume you've got 100 grand in the bank. And here's why it's a fantasy world. You're earning 7% right now. If you don't touch it in 10 years, it's gonna be worth about $200,000. If you got 100 grand in account and it's compounding 7%, over 10-year period is gonna be worth $195 or $196. Then you've got $100,000 in debt, but you are paying 8% interest. That's probably not a fantasy world. That 8% could even be low depending on the type of debt that you have. And if you don't pay the debt over 10 years, that balance will be $215,000. Because we've got 8% interest and we're only earning 7% up top. Some options, so you've got that $100,000 in cash. Option A, leave money in the bank, earn 7% every year. That means in 10 years, you know you're going to have $200,000, assuming you never touch it. The problem with this is you still have the debt. Option B, pay off the debt, pay the debt off. The drawback for this is the bank account is empty, but the advantage to this is no more debt. So what we're gonna do is to start refill that bank account over time. Option C, fantasy world. Let's assume you pay off the debt with the money that you have in bank account, then start to put the $100,000 back into the bank account over 10 years. But in 10 years, is worth $200,000. Same amount as if you never touched it in the first place. Option C is not a fantasy world. What it's using here is a cash value life insurance policy. Understanding exactly how to get the most cash value, because where people have buyer's remorse with whole life insurance, every single time the cash value, they told this policy is set up for maximal cash value, and then they find out it's not. They could have more cash value with the exact same product, with the exact same company, but they were not informed of those options up front. That is where buyer's remorse occurs in this industry more than anything else. Let's go through how whole life insurance works. Couple points around the cash value, then how to get as much cash value as possible. So with whole life insurance policy, here's our chart. We have the death benefit is the benefit that is paid when you die. If you have a life insurance policy on you, life. Now, what you'll see with whole life insurance policy will gradually increase over time. Now, then we've got your payment. This is money that you're paying into a policy. We'll assume that this is level. And then we've got the cash value will gradually increase over time. Now, when we look at the cash value, this is what people are interested in when it comes to a whole life insurance policy. And here are the reasons why. Number one, it's a safe place to put money. When we look at the actual results of whole life insurance policies that have lived the test of time, meaning not just illustrations, but real results, typically see a net growth rate somewhere between 3 to 5%. And that's without any risk, access anytime without penalties. Money keeps compounding when you borrow. Tax benefits, especially for folks in higher tax brackets, it's got a very nice tax benefit.